What's up, folks? Welcome back to the channel. This is Jason, host of Fighting Words Financial, and let's talk about what is a growing banking crisis. And I'm not talking about the one that we have just gone through that has created a lot of uncertainty. I'm talking about the next one on the list, and that is going to be office real estate. Not commercial real estate in general, but in particular office real estate. And let's talk about that because this crisis is going to unfold kind of slowly over the next couple of years, and it isn't going to be evenly distributed across banks. Some of them are going to get hit very hard, and some of them are going to be relatively immune to this phenomenon. So let's talk about what I mean by this, okay? So when this news came out last month that office occupancy hits a post-pandemic high, it sounded like good news from the headline, but when you take a look at this graph, it is definitely not good news. So based on 2019 numbers where office occupancy was around 100%, it has returned to about 50.4% of that number. And that was as of last month. And I have the latest numbers here just from the last week, and it's actually a little bit worse. But what does that really mean in terms of office real estate? At the beginning of the pandemic, I made a prediction in a bunch of videos that about 30% of workers that went home were probably never going to come back to the office. They're going to end up working from home, essentially full time. And now what we're looking at is that number probably being a lot more than that 30% that I initially predicted. And that hybrid working environments where you spend a couple of days working from home and a couple of days working in the office, that is becoming the new norm. And I think it's going to be very difficult to shift people away from that, as companies are seeing this now as a way to recruit and retain employees. So even if you want your employees to be in the office 100% of the time, it may be very difficult for you to find employees who are willing to work under those conditions when they can get equal pay for different working conditions where they work 3 days in the office, 2 days at home, or 2 days in the office, 3 days at home. And this is actually already being reflected in the numbers. So this right here, when you look up office occupancy rates, you may pull up something like this U.S. office rents reports. This report that comes out where it talks about maturing loans pointed to increased uncertainty in the office sector. So the average U.S. office listing was about $38.28. It's down 1.6% year over year. Let's remember, though, these leases are extremely long-term. A lot of times when it comes to offices, we're not looking at 1-year leases like in terms of apartments. These are anywhere from 2 to 20-year office leases. So there have been very few declines in this so far, but office vacancy rates are at about 16.5%, which is relatively high, and that's on average for the whole United States. When we are looking at areas like Houston, Atlanta, and Austin, they have the highest vacancy rates that are all north of 20%. And I think that the vast majority of this is due to, of course, the new hybrid working environment. This number, though, doesn't really tell the whole story, and it can't at this point, because what's going on right now is that all of these offices are at 50% capacity right now. People are working in hybrid environments. But these companies are still stuck with their long-term commercial leases. It is extremely difficult to get out of a commercial lease. I've tried it before and it didn't work. I ended up just eating the loss and having to move on. And most companies are facing this as well. And I think even Elon Musk at Twitter tried to break his commercial lease and at this point has not been able to do that. But as these leases come up for renewal, more and more of these companies are going to either not renew their lease at all, or they're going to renew their lease at 50% less space, which causes issues with all of these loans that are maturing over the next couple of years. How are these office companies going to be able to refinance their loans and keep operations going? How are all of these real estate investment trusts that are focused on office space going to be able to finance purchasing new buildings when we're looking at the cost of capital being much higher, occupancy rates being much lower? So something is going to happen with all of this office space at some point. We may be looking at conversions into housing to some degree. That's going to be easier in some markets than it is in others. But there is sort of a slow moving apocalypse that is going to occur with commercial real estate here. Now, where does this data come from? This data, for the most part, comes from a couple of different companies. One of them is Castle, and these are Castle basically is an access control company. So they know when you're swiping your card to get into your office. The barometer this week for Castle's back to work barometer is only 48.4% over the 10 largest metro areas in the United States, the largest office metro areas in the United States. So this is definitely not a good sign when it comes to real estate investment trusts that are focused on office buildings and when it comes to some banks. Now, like I said before, this is not going to be a crisis that affects all banks like it did with collateralized debt obligations. There were very few banks that had no exposure to that. This is not going to be something like a Silicon Valley Bank, but we are going to see several banks in highly concentrated areas like San Francisco, Los Angeles, Austin, Houston, New York City, Chicago, in that area. Those companies are going to be trying to divest themselves ahead of time of their loan portfolios that are involved with commercial real estate, and they're going to be focusing on finding alternative business to do in their areas, because the business of refinancing these buildings, first of all, it may not be possible based on the credit ratings of some of these companies going forward, and the fundamentals might not make sense. So this might be a revenue opportunity that is taken away from some banks. Now, predicting which banks are going to fall victim to this and which banks are going to sail by with relatively no exposure is going to be really difficult, and you're going to have to be a lot more industrious when it comes to doing your due diligence on these companies when you make these investments. So that is my advice to you guys. Do all of your due diligence. Of course, this is not an endorsement to buy, sell, or hold any security that's out there. You're really going to need to dig through the holdings of the banks that you're invested in here in the near future. In any type of rising interest rate environment, it is generally true that financials do very, very well, but you do have to pick and choose which financials you're investing in. And when we see this deflationary cycle that we go through, or at least the cycle where interest rates are declining, you're going to see that credit spreads are still going to be very, very healthy for financials. And there's going to be a huge difference between financials that do really, really well and financial companies that are going to be caught behind the 8 ball when it comes to this office real estate apocalypse. Anyway, folks, that is just my short video on what I think is the next ball to drop for the financial industry. Looking at some of the newer companies that are out there in the fintech space, they will have almost zero exposure to this. And some of the stock prices for these companies are depressed far more than is really justifiable by their fundamentals. And these folks are going to sail past a lot of these real estate issues here that are coming up in the future. So keep an eye out for companies that you may never have thought of before. Keep an eye out for value companies that are not really heavily invested in office real estate. And anyway, folks, that is just my take on this. Feel free to disagree with me in the comments below. I look forward to hearing from you. I get a lot of my video ideas from comments that are made, and I look forward to seeing you folks next time. And I'll be doing a live stream later on today. Thank you very much, and have a nice day.